My ATR strategy made $12,000 in backtesting. But is that edge real, or did I just curve fit to Bitcoin's volatility from 2024 to 2026? Today, we stress test it with walk-forward analysis, Monte Carlo simulations, regime defense filters, and drawdown analysis. This is part 4 of the Triple EMA series, and this is where we separate real edges from backtest illusions. But first, let's be crystal clear about methodology. In part 3, I ran the backtest on the entire dataset without splitting it into in-sample and out-of-sample data. That's not proper validation. Today, I'm showing you the right process. We split the data up front, optimize on in-sample data, test on out-of-sample data, and run walk-forward windows to check parameter stability. If you're building your own strategies, do this from day one. Don't make my mistake. Let's start with walk-forward analysis. We split out data. 70% for in-sample optimization, 30% locked away as out-of-sample test data. We train on the first half, test on the next quarter. Then we expand the training window, test again. Finally, we test on the fully unseen out-of-sample data from late 2025 to mid-2026. The results: the first walk-forward window shows a profit of $1,552, with a profit of $1,552, with a profit factor of 1.14. Solid. The second window shows a loss of $577 with a profit factor of 0.95. That's a warning sign. The final outer sample test shows a profit of $550 with a profit factor of 1.026. What does this tell us? The edge survives on unseen data, but it's fragile. The out-of-sample profit is only 6% of the in-sample profit. A robust strategy would maintain at least 50%. This doesn't mean the edge is fake. It means it's regime dependent. It works better in some market conditions than others. And that's exactly why we need the next test. Monte Carlo simulation. We run 3 stress tests. First, sequence risk. We shuffle the trade order 1,000 times to see if we just got lucky with the sequence. The equity curves show a tight confidence band around the mean. The 5% percentile stays profitable. This proves the edge isn't luck. Second, execution noise. We add random slippage and spread variation of plus or minus 0.05% per trade. The equity curves barely move. The mean final profit stays around $8,200. This proves the strategy tolerates real-world friction. Third, parameter perturbation. We vary the ATR multiplier between 1.5 and 2.5, and the risk-reward ratio between 1.5. The confidence band widens significantly. The 5% percentile drops to around $1,400. This reveals parameter sensitivity. The strategy works, but is not stable across all parameter values. Calibrate it to your asset, your time frame, your broker. Don't blindly copy my ATR times 2. Now, regime defense. We tested 5 different filters to avoid toxic market conditions. First, volatility-only filters to avoid toxic market conditions. It paused trading too aggressively and produced no trades. Fail. Second, trend-only filter. It improved the profit factor to 1.18 and net profit to $8,020. This works. Third, combined relaxed filter. It maintained a profit factor of 1.2 but reduced trade count to 99. Too conservative. Fourth, volatility switch filter. It kept the profit factor at 1.08 with 1,105 trades. This is promising. Fifth, structure filter based on higher highs and lower lows. It produced no valid signals. Needs refinement. The winner? The trend-only filter combined with ATR stops. But here's the critical question. Why did the trend filter barely help in part 3, but now it's boosting performance? The answer is synergy. In part 3, we tested the trend filter on fixed 1% stops. It helped slightly, but was fragile. Now, ATR handles volatility breathing, and the trend filter handles direction. They compound. ATR reduces false stop-outs. The trend filter keeps you in high-probability regimes. Together, they create a stable edge. Alone, they're fragile. Drawdown analysis. The maximum drawdown is 16.05%. Let's put this in context. For a personal account, 16% is survivable, but psychologically taxing. You question the strategy during the drawdown. For the prop firm challenge, 16% is a hard fail. Most prop firms have a 10% maximum drawdown limit and a 5% daily loss limit. This strategy would blow the account. The solution? Add a hard daily loss limit of 5% or reduce risk per trade from 1% to 0.5% for prop firm compliance. The edge survives, but you must adapt the risk parameters to your account type. Community optimization ideas. We tested 5 viewer suggested filters. RSI regime filter boosted profit to $8,121 with a profit factor of 1.2. Trend filter improved it to $7,697. Volume filter helped but reduced trade count to 562. Session filter for London and New York overlap showed modest improvement. The custom regime defense was too aggressive and barely traded. Simple filters like RSI and trend confirmation add value. Complex custom filters risk overfitting. Part 5 preview, live deployment. Validation is complete. The edge survived stress tests, but with caveats. Now we deploy. We'll compare 4 platforms. MetaTrader 5, the prop firm standard with low latency but Windows native limitation. CTrader, cloud native with modern REST and WebSocket APIs. MatchTrader, web-based and easy to scale, but newer with fewer documentation resources. Crypto exchange APIs like Bybit and Binance, direct exchange access 24/7 but no prop firm compliance. In Part 5, we'll bridge Python to live execution, implement real-time risk controls, set up monitoring dashboards, and run a public paper trading test. No more simulations, just execution. Subscribe so you don't miss it. Trade systematic. Verify everything. I'll see you in Part 5.